Today, and as we look at student loans, we look at a very different world than even just a few years ago.
For starters, obviously, we have a marketplace that is demanding post-secondary education more and more. Secondly, obviously, the Great Recession, I think, precipitated in as much as students were not able to find work after high school, that higher education became the route.
At the same time, people didn't realize the extent to which college costs were increasing even faster than the cost of healthcare. So we saw more and more students having to take out loans and becoming burdened by debt.
We had no idea how much borrowing was possible, what the consequences of excessive borrowing among a growing number of students might be, and we're paying the price today in terms of $1 trillion in outstanding debt, in terms of rising levels of per-student indebtedness, et cetera.
So times have changed, and I think our policy work really has not kept up with a lot of the changes that we've seen.
And in the 1950s, there was a huge hue and cry in and around the city of Boston about how the price of higher education was getting completely out of control. Basically what happened is that the upper income executives in downtown Boston began to get frightened. They wouldn't be able to afford to send their kids to Harvard, Yale, and Princeton and those other high-tone places the way they had gone to those places. They had a big fundraising campaign which they thought was going to be for scholarships. But when they began to think about it, they thought, we can't possibly raise enough money to give scholarships to all the kids who need scholarships, but we can leverage this money through a loan program. And they did. They created a reserve fund, which is a fund which you draw on. You go to a bank and you say, look, bank, if you'll make a loan to these students, we'll guarantee that if they default, we'll pay you back. But the pattern, the notion of leveraging of a loan program instead of a scholarship program had been established.
The National Defense Act of 1958 was the first major effort after the GI Bill to help students study, especially sciences and engineering, that would help us build our capacity for defense. So the National Defense Education Act was allowing schools to, among other things, give out student loans.
And now we fast forward to 1965. Lyndon Johnson had absolutely as his first priority in the war on poverty getting more people through higher education. He essentially wanted to start a national scholarship program which would enable anybody to go to college regardless of need. Word came back, essentially, look, Lyndon, it's just too expensive. We can't do this. LBJ sent his folks out. He was a master of dealing with the Hill, and he figured out that these guys were worried about how they were going to pay for their own kids' college education, just like those Massachusetts execs were back in '56. Word went up to the Hill, look, we think that in addition to the National Scholarship Program, there ought to be a national loan program which will help middle and upper middle income folks just like yourselves. So what we got was a kind of trade-off. We got a deal. The deal was you can have your scholarship program if you give us also a loan program. And that's why the Higher Education Act of 1965 had both a scholarship and a loan program in it.
So as often happens in federal policy, they looked around for a model program. Well, what could we do? Oh, well, here are some state programs. Well, let's just take this state initiative and make it universal across the United States.
The banks weren't very interested in this. The banks thought they weren't going to make very much money on it. It would bring droves of young kids into their lobbies. But faced with a choice of federal government does it or we do it, they took, we'll do it.
The federal government would guarantee loans through agencies in various states, and banks and other financial institutions would put up the money, would actually make the loans.
So this is how we ended up with this really kind of complicated public-private partnership.
It began to really grow in the 70s and 80s, and with the growth became a whole series of problems.
In 1972, we added Sallie Mae, a secondary market, to buy the loans from the lenders to provide the lenders with more capital and more liquidity, or to warehouse the loans, which means to hold them temporarily as security for a loan from the secondary market to the original lender. So it was a very highly complex enterprise. Very few of the policymakers understood what Sallie Mae was about.
The next big changes occurred with amendments in 1978, and that was really when the Middle Income Student Assistance Act came into being.
Middle Income Student Assistance Act was basically a political effort on the part of the Carter administration and Democrats to head off tuition tax credits.
There was a thrust that said, well, gee, we need a broader political base. Maybe we should be trying to do some more for middle-income students.
And the Senate took away the income requirement for the Guaranteed Student Loan Program to include the in-school interest subsidy eligible for all.
Once they did that, the numbers got too big, 78, 79, and 80. The cost of the program exploded.
You started to have budget considerations come into play. Ronald Reagan had been elected president. He felt as though the federal budget deficit was out of control. That's how we got the borrower loan origination fee. I was on the Hill when that was enacted, and Republicans were going crazy. They knew that it was bad policy, but they also knew that it was necessary to meet these stringent budget savings requirements.
And then in '81, Reagan and the congressional Republicans repealed the Middle Income Student Assistance Act of 1978.
There was still a need to provide more and more assistance to families, and the PLUS program was created to do just that.
The original title of the program was Parent Loans for Undergraduate Students. The idea is that parents would be able to borrow money in addition to the money that the students borrowed to help meet the total cost of education. Originally, parent loans were capped. You could only borrow up to a certain amount. In the course of things, that legislation got changed so that the parent loan programs had no caps. You could borrow up to the total cost of education minus other aid. We finally got to the point in the early 80s where the volume was so great, people for the first time began to worry about A, default rates, and B, cost to the government.
We required audits, we required scrutiny of institutions, and they continued after that to grow even stronger. What I mean by stronger is not only the abuses growing stronger, but the voice for controlling those abuses growing stronger.
You know, I don't think the institutions themselves ever really saw themselves as being particularly responsible for the integrity of the student loan program.
When you get to the 1990s, you still have that focus on default and the federal budgetary consequences of default.
Senator Sam Nunn had a committee that was investigating dramatic increase in student loan defaults, mostly at for-profit colleges, a lot of kind of fly-by-night operations.
The average default rate was 22.4%, which is shocking. Essentially meant that nearly 1 out of every 4 loans were going into default.
The Secretary of Education, Bill Bennett, suggested the idea of eliminating colleges with high student loan default rates.
It then took 6 years before we really mustered the full political will to put in a framework in the Higher Education Act to permanently address some of those challenges. Along the way, there were a number of provisions that passed kind of 1 or 2 at a time, and that was primarily because this was the era of Grand Rudman's, Hollings, and balanced budgets, and so you had these special budget cutting bills that went through. And we really used that as a tool to pass some fraud and abuse provisions that saved taxpayers money, brought integrity to the programs that might not have gotten through if they weren't in a budget act.
It was one of the provisions in a reconciliation bill in 1990 that established the cohort default rate as a trigger mechanism for termination of participation by an institution in the Title IV program.
In the early 90s, we started experimenting with what became known as direct lending. One big reason was the costs.
The debate at the time really was focused around how should loans be made? Should they be made directly by the government, or should they be made by banks but subsidized by the government?
The Department of Education thought, boy, we could do this much more cheaply. Pretty soon, Congress was asking, hey, what about this direct loan idea?
There was a recognition that if you move to one where the federal government was lending the money, the taxpayer would be better off, and potentially the student would be better off.
Direct lending was actually started as a pilot program, a small pilot program, in the 1992 reauthorization. It went from a 1992 pilot program to a much more full-fledged effort program in 1993.
The reason for finally getting to 100% direct lending in 2010 was the meltdown in the credit markets. The banks could not provide all of the capital that was needed for federal student loans.
We realized that billions and billions and billions of dollars were going to private lenders to support a federal lending program. We realized that we could do this much less expensively if we moved to direct lending.
One of the biggest times of growth was the early 1990s when the unsubsidized Stafford Loan Program was added.
The 92 HEA reauthorization is probably remembered most for the fact that it's when the loan limits came off, when we created a much higher levels of indebtedness. That was not the intent in the 92 reauthorization. But I think what was driving those conversations was a couple of things. One was that the rising price of higher education was creating more and more barriers for individuals. So there was not an intent to create more debt. There was an intent to create more opportunity for people by creating greater access to larger amounts of money.
The idea of creating more lenient, more workable, more flexible repayment options became a very important priority, and we began to see those incorporated.
Students had borrowed significantly, and the fear was that once they got out of college and got into repayment, that they would be hit with a bill that they might not be able to afford initially. Certainly, income contingent repayment was one as a way of reducing defaults, and at the same time allowing students to pay on an income contingent basis, and as their income grew, they would be less likely to default.
But only direct loans were eligible for it. So the income-based repayment plan came about in 2007, and it was thought at the time trying to kind of combine it with income contingent repayment would be complicated, and it was easier to just create a new plan than to try to blend the two together and figure out what to do about the borrowers who were already enrolled in income contingent. So then we had two plans. President Obama proposed to improve income-based repayment, so that led to the creation of what is now called the pay-as-you-earn plan. There are currently 3 income-based repayment plans, and there are about to be 4, and everyone agrees that's too many. It's too complicated to force borrowers to figure out which one do they qualify for and which would be most beneficial to them. So the question is always, why do we have 4 income-based repayment plans when it clearly is too complicated? And the answer is no one ever suggested that there be 4.
The extent to which people should be relying on loans and the extent to which they should be subsidized by the government is something that we've come to not by design so much as by accident and by the political dictates and the dictates of the federal budget.
The initial belief was that they would benefit middle-income families, but I think the reality is more and more low-income families have had to utilize those loans as college costs have increased.
We've seen an interesting evolution in terms of the student loan programs, from creating greater access to loans to ensuring that defaults don't happen, to what we have now contemporarily, which is this interest in debt. But that really has been an evolution 30 years in the making.
The original blueprint has changed pretty dramatically, resulting in greater reliance on loans than anybody in 1965 would have possibly envisioned.